everyone. Nice to be here with you. I'm sorry I just got here. I was not around for the earlier part of the day, but I'm sure this has been touched on a little bit. Just a show of hands, how many of you kind of work in finance or is finance adjacent, just so I can tailor it on the fly? I was told to keep it kind of broad-based for everyone to understand, but just for me to know. Okay, about 10 of you. Okay, great. Okay, so just a bit of an introduction about Sustainable Fitch. You might be familiar with the name Fitch from our sister company, Fitch Ratings. They're a credit rating agency. We are the ESG ratings and research arm of the larger Fitch group. So what I do is sustainable finance research focused on fixed income. And that's just because of the legacy that Fitch Ratings has established. We operate in credit markets. So I'm going to introduce you today to the labels. And like Magali said, there can be a lot of confusion around bonds. They're much less sexy than private equity or equity in general. And I'm sure you've heard the term sustainable finance thrown around through all swaths of the sustainable finance market, whether that's private equity or impact investing. But I'm going to show you what that means within the bond and loan space. Okay. Okay. I hope this is a little small, but I hope everyone can see it. So I think I just want to start the presentation by framing why is sustainable finance important. This is a term that's been thrown around so much, I think, in the last, more recently, 6 to 7 years, where it's become a lot more prominent. If you look at it from 3 different angles, there's a risk management angle, there's a value creation angle, and then there's just the part about meeting your stakeholder expectations. So firstly, let's just touch on risk management. So I have conversations every day with investors, asset managers who, have 20, 30 years of experience in bond markets. Sometimes they're like, ESG, why do I need to care? I don't care about alpha. Fair point, sir, ma'am, point taken. But I think what we need to realize is that for institutions and companies, there are so many risks that are coming up because of the changes that the climate is presenting, right? That could be transition risk, physical risk, and I'll go into that a little bit later in the next slides. But the point of it is you should be managing it from a risk perspective so that you're future-proofing and safeguarding your business. Whether that's a corporation or if you're an investment and you have an investor and you have a portfolio that you have to manage, you're safeguarding those future returns to make sure that you are ready for whatever Mother Earth throws at you in the future. The second is capital allocation and returns. So we're increasingly seeing, new tech come to market. There's so much investment going into things like low carbon technology across hard to abate sectors, even just, sorry, I'm blanking out in terms of the examples at the moment, but something along those lines. And there's a lot of capital being put towards these technologies, and early investors, you'll see that you really get a boost from getting on board with these investments before it becomes mainstream, because you capitalize on it, you're able to generate revenue, whatever, before everyone else kind of catches on to the trend, and then it becomes a lot more mainstream. And the last part is regulatory and stakeholder expectations. So if you're in Singapore, the MAS has been actively working on regulations to address a whole host of issues, from climate reporting to asset managers and the compliance that you have to do as an asset manager if you're managing a portfolio, and even stakeholders. So if you're an investor or a corporation, and you have investors who invest in you, they are going to be increasingly demanding information from you, whether that's sustainability related, climate related, because they have to do their own reporting to their own stakeholders, their end investors ultimately. So that's another angle that you can look at it, is why it's important. You need to comply with all these regulations that are coming out around the world, and not just Singapore, across ASEAN, across wider APAC, the world. So you'll see regulation that comes out in the EU, and you might think, oh, that's really far away from us. They're much more advanced. No, I can tell you, I'm part of those conversations in APAC across, Hong Kong, Australia, here, and people are losing sleep at night over these issues. They're really trying to find out the best way that they can to make sure that all these structures are set up and they're robust, so that, you don't run into future problems where there are accuracy issues and greenwashing and reputational damage and all those sorts of things. And also, countries are kind of vying to be the sustainable finance hub in APAC. I think that's a line that the Singapore government has put out. They're really actively trying to position as a hub, whether that's in terms of arranging deals or attracting private capital and, putting that towards catalytic capital ultimately. But these are the 3 main lenses. So if you're ever wondering why it's important, these are reasons. Okay, so I just want to go a bit into climate risks, like what I said earlier. So here are just 6 main types. Risk is quite a broad term, so I just want to contextualize this for anybody in the audience where this might be relevant to you. So in our world, we talk about all these 6 kinds of risks. Physical risk, which is obviously the most immediate, most obvious kind of risk that will be posed to any organization. That would be the immediate damage or effects that come from exposure to natural disaster. Especially in ASEAN, we're one of the regions that is the most exposed, unfortunately, to you know catastrophic weather events. So that's the first type of risk. The second is transition risk. So that would relate to the financial and operational impacts of the changes that are happening in the wider ecosystem and how that would impact the company. So whether you're positioning and you're in a hard to abate sector like shipping or cement, and we know that that's not as easily, you can't greenify that overnight, unlike some other industries where there are scalable solutions. So that's another type of risk. Regulatory risk, so the rising cost of compliance, reporting, all those sorts of, kind of back end things that you have to do to your various stakeholders in whichever jurisdiction that you're based in. Legal risk as well. So, if the company is found contributing to very severe climate harm, whether you're an oil and gas company or you work in cement and you're doing some kind of pollution, activist groups will come at you and try and slap you with lawsuits and things like that. And that has happened. Not as much in Asia, I would say, more so in Europe, where a lot of these structures are much more developed, but we're increasingly seeing those vocal voices come out to the fore to say, this is not right. You should be looking at your internal operations. And then you see activist groups put out statements and, it creates a whole headache for your internal legal team. And the last is reputational risk. So any damage that's done to your company just from an optics point of view. The most, I guess, high profile one I can think of is maybe Deutsche Bank and not Deutsche Bank, Volkswagen, and the whole emission scandal, Dieselgate that happened. So they had a lot of, backlash. And fun fact, I was a financial journalist before this, and I covered that development from Singapore. So it was bad, guys. We were hearing from so many insiders about what was happening, and it was a headache for the company and people involved in the company, not just leadership, but everyone, within organizations that worked and believed in the claims that were being made, and unfortunately were blindsided by that. So these are the 6 kinds of risk that we speak about with investors often. So these are just some examples. I know the previous slide is more the theory, but just to give you more tangible examples, hopefully, relevant to some of your sectors or where you work. Physical risk could be a coastal data center that encounters some kind of typhoon or flood or storm surge. The impacts from that would be your delay in operations, the damage that you have to pay to rectify, and just overall higher insurance premiums. So we are seeing that across the insurance sectors. And, we speak to a lot of insurers as well who are trying to position against these sort of risks because they have to insure them. And when something happens, as you know, even in personal accident insurance, when something happens to you, your premiums go up, unfortunately. So that's something that you would have to deal with as a business. Transition risk would be a cement producer who's facing rising carbon prices. So that could be in the form of carbon tax or an emissions trading system. Increasingly, you're having to look into that for a license to operate. You need to be accounting for those costs on the back end to make sure you can continue to make revenue. And if you don't, unfortunately, compression to your margins, you get stranded assets. Maybe you have certain plants that, are kind of behind the curve. And unfortunately, investments, you're not really able to raise to upgrade or expand or things like that. And all of that, interestingly enough, can lead to credit rating pressure. And I know that seems kind of far off, but if anything impacts your financials and your ability to pay your creditors, credit impact pressure, whether you're going to default or, ultimately, are you going to be able to make those payments back? The next is regulatory. So we have an internal regulatory tracker where we track all kinds of financial regulations related to sustainable finance across major jurisdictions in the world. And one key one that keeps popping up in conversations with asset managers, FIs, corporates is ISSB. So Singapore has also started implementing, or they're going to phase in implementation for climate reporting. And ultimately, that leads to you needing to hire people to get that data. Unfortunately, in APAC, we are slightly earlier in our development journey. Not as many people are focused on this as part of their career compared to a place like Europe. Magali in France, they're quite advanced with this. So you have to hire people, staff, make sure you're getting the right data, hire third-party providers to make sure that you're doing all kinds of complicated calculations with regard to your GHG emissions and your pollution that you're generating, or the social impact that you're having. How many women are you supporting in the community and things like that. Okay. A market, this is more maybe for consumer companies where you have, or you sell appliances, right? And you're increasingly seeing that your customers are demanding more energy efficient appliances. And if you're not keeping up with your stock and, the models that you create, you're going to lose demand for the previous high intensity or high energy demand products. And obviously, again, that hits your bottom line. So as you can see, the theme here I keep going back to is your bottom line, the revenue and the profit that you generate and the cost that you incur. And the last two, I think, quite related. If you get slapped with a legal suit, if you're a utility company and you're accused of negligence, which has led to some kind of, catastrophic situation like wildfires, you can be slapped with litigation expenses, regulatory fines from the regulators in your country and authorities. And that obviously also leads to somewhat reputational damage because you've just been seen as negligent. Maybe your internal controls are not that great. That calls up questions about how you're operating internally. Do you have risk committees that are looking at this? What is your board discussing? Why are they being paid so much money? And this is not being addressed. So all kinds of headaches related to these things. So this brings me into my next part of the presentation, which is the ways in which you can raise financing to hopefully mitigate your risk against some of those risks, or mitigate your exposure to those risks, excuse me. So in sustainable debt, we primarily look at bonds and loans. Now, loans is a slightly more opaque market. There is less regulation around it. They tend to be privately executed deals, so it could be between a bank and the corporate client that they're lending to. And oftentimes, those corporate clients don't have to reveal information about, what they've committed to, what is their progress on hitting those targets they've, pledged to, or how much money has ultimately been raised and funneled towards the projects that they said this was going to finance. We unfortunately don't have access or freely to that information, more on an anecdotal basis. And when I speak to the bankers, sometimes I prod them, my externalism curiosity. I'll be like, so what did you finance? And you'll see they'll be a bit mum about it sometimes because they don't want to be caught out. But with bonds, it is much more transparent. And that is just the structure of the market and how it's developed so far. So some of the labels that we've commonly seen debt be issued under, these are the three main kinds: green, social, and sustainability. So, for example, with green bonds, the use of proceeds from those bonds and whoever has invested the money, that money that has been raised, goes towards exclusively green projects. So, for example, this would be renewable energy related projects. If you're creating a new solar farm or a wind farm, right? That's very clearly green. The next, with social, those are positive social outcomes or projects that generate positive social outcomes. So that can relate to socioeconomic advancement for women, affordable housing, access to essential services, affordable healthcare. The list really goes on very far. And the last is sustainability, and that is a mix of the two. So if you're raising a sustainability bond, you retain the flexibility to decide whether you want to allocate to a green project or a social project. And that creates a lot more room for interpretation sometimes in what certain corporates do when they allocate the funding, but ultimately it is a little bit more flexible and tailored to their needs. So I just want to explain a little bit about what governs those three labels. Globally, we have a lot of frameworks. So in Singapore, we had the Singapore Asia taxonomy. In the EU, you had the EU taxonomy. Across Asia, really, and I think that's something to be proud of, we have really led the charge on creating taxonomies that address a lot more sectors that maybe Europe doesn't have to deal with. So historically, you will see a lot of corporates and investors, if you're in your conversations day to day about this, if you are indeed talking about this over coffee, you'll see that everybody refers to the EU taxonomy. That is primarily because it's a legacy framework. The EU has been leading in this field for a very long time. And in terms of the regulatory aspects, they are a lot more advanced. So the EU taxonomy was sort of the first globally accepted official framework. And you'll find that sometimes even Asian companies will continue to refer to them. But over time, over the past few years especially, there has been a lot of conversation that has happened around the need for more localized approaches. Because, for example, it's pretty quick. Sorry, I'm being given a 5-minute flag before Q&A. So I think, in countries like Indonesia, which is very coal intensive, unfortunately, a lot of activities that you want to finance and you think, oh, that's a really good opportunity, you're precluded from doing that under the EU taxonomy if you are reporting under EU taxonomy or EU related guidelines, because they have very strict ring fencing around anything coal related because that's dirty. But that's just an example. So Singapore's got a taxonomy. All our neighbors have a taxonomy. The most recent one to publish was Australia. They have a very, very interesting approach. They've really taken their time to assess what's currently out on the market and present something that is very applicable to the Australian economy. So hopefully that catalyzes capital for their various sectors. So in Australia, you have something like the agriculture is such a huge part of their economy. Singapore, unfortunately, as much as we tout, rooftop farms and things like that, it's just not a core part of our GDP. So we don't necessarily have a carve out for, or as clear a carve out, I should say, for those sort of activities. But yes, those are governed by taxonomies as well as the ICMA principles. So there are the green bond principles, social bond principles, sustainability bond principles. The ICMA is really sort of leading on this charge, and those are voluntary guidelines, but they're very much seen as the pinnacle of regulatory guidance. So recently they've come out with transition bond principles after much demand from the market around the transition label. So I'll just move on to the next slide. These three other sort of label types are much newer to the market. Sustainability linked came to market, or the first bond I think was issued in 2021, if my memory serves me correctly. Unfortunately, there has been some controversy around this label. It is different from a use of proceeds structure where it is not financing a specific project. Instead, a company will come to market and they will raise financing with a pledge to hit certain targets. So let's just say you're an oil and gas company and you've raised an SLB, sustainability linked bond. You might say, okay, the financing that I raise from this is tied to me achieving a 20% decrease in my GHG emissions against a baseline year of 2018. So maybe that would be 30% decrease. And they'll have interim check-in points where they have to report their progress against those metrics. And if they don't, by the end of the bond, hit those targets, a coupon step-up is triggered, which means that the corporation has to pay more to their investors who invested in this bond as a punishment, so to speak. There are other structures in the SLB market. I won't go into that necessarily right now, but that tends to be the main one where you'll have to increase the interest paid to your investors because you didn't hit your targets as you promised. The next is transition. So you'll see a lot more commentary around transition bonds. This is much newer to the market. Up until last month, there was actually no combined regulation or guidance around this, but ICMA has come out with their own bond principles. The Loan Market Association has come out with their own principles for loans as well. So our prediction at Sustainable Fitch is that we will see more bonds issued under this label. But prior to this, there was a lot of confusion around what can be considered transition, right? Because it's open to interpretation. And, there was concern around transition washing, where you're saying, oh, we're going to use this to greenify our operations and make it lower carbon. But actually, you might be a company that is already in a heavily pollutive industry and you're just investing in a technology that makes your operations slightly more efficient, but you're locking yourself into longer term carbon emissions because you're not really making an active change to make it green. You're just lowering carbon emissions ever so marginally. But hopefully with the guidance, that means things will be a little bit more structured and better. And the last would be sub-labels. So blue would still be categorized under green. And I know that's a bit confusing, but it's kind of like an umbrella. Green is a larger theme. Under that is blue. So blue bonds would go towards water-related projects or ocean-related projects. That could be aquatic biodiversity conservation or something along those lines. We also have orange. So orange is a lot newer as well. And those are actually gender-focused projects. So as you can imagine, that falls under the social umbrella. So a lot of these projects need to have gender-related outcomes, primarily focused typically on women. So SME lending to women-owned businesses, allowing access to essential services for women, education, things like that. This is just okay, I'm sorry about the legend there, but just as you can see by the color, green has tended to dominate the bond market traditionally. Again, because it is the longest standing instrument, it is the most structured, it is the most established. So green has continued to be the most popular, and 2025 is year to date, but that tracks with the larger fixed income market and how markets have been doing globally. So as you can see, it's slightly lower. Sorry, I don't have control over that as much as I try to discuss and promote the opportunities. The next, actually, interesting point is that we've seen social bonds really see a spike, especially post-COVID. So there were a lot of disruptions to social infrastructures during COVID time. So we realized people didn't have access to good healthcare. A lot of people, especially below the poverty line, were suffering, right, because of access to jobs and things like that. So a lot of the bonds that have come out have really been targeted towards uplifting segments of society. And that is one particular reason why. The other is just that social has really gained traction, especially over the last few years under the Trump administration, where ESG has gotten so much backlash. So investors are looking at ways that they can invest money and still get alpha back, but also have a positive, outcome ultimately from that. And ESG is really, or green, has kind of become a bit of a target. So they've moved over to social a little bit. Not so much in APAC. I think APAC, there is a need and a recognition that, local indigenous communities, for example, you need to be addressing what's happening with them. So again, going back to the example of Indonesia, a lot of the local economies are engaged in informal work, coal mining, in villages, or nickel mines and things like that. And you'll find that this term just transition comes up quite often, because you can't just be changing your business model and then leaving your entire workforce stranded without a new skill set, because this is all they've ever known. So social bonds have come up to kind of address that gap of education and upskilling, reskilling, things like that. Sustainability has kind of remained even year on year. And again, that's just because of the flexibility, but I don't really see that moving up or down. I think it depends on your company's needs at that point in time, and whether or not you want to have one combined framework rather than have one for green, one for social, and so on and so forth. And then there's also rising interest, of course, in the niche labels that I talked to you about: transition, orange, blue, Amazonia bonds, nature bonds. Those are much newer. And in our view, those offer opportunity for very experienced investors. But of course, if you're new to the bond market or the debt market, that can actually cause a lot of confusion for you, because you've not even kind of hit the base level of green. And then you're trying to get more involved in complex financing structures, which require a lot more advisory work to be done for you, a lot more reporting that you have to do on your end. So experienced stakeholders, that might be relevant for you. But if you're new, just go for the established ones. Okay, this is loans. As you can see, less points here. Like I said earlier, it is a very opaque market, but primarily sustainability-linked instruments have been very popular in the loan market. Again, due to the flexibility, companies oftentimes, when they go to a bank and they try and raise financing, they'll say, we would rather pledge towards certain goals, but we have autonomy over how to reach those goals. So we're not going to pledge to build a renewable energy plan. We're not going to pledge. We need some time to figure out company strategy, and the sustainability linked format gives us free use of the money as long as we hit those goals at the end. So you can imagine why a lot of corporations would appreciate that structure a little bit better. And then given that loans are private or tend to be privately handled, even better, because there's less public scrutiny on your deliverables and your performance and things like that. Okay, so when we talk about use of proceeds, that's the money that goes towards whatever the projects are being financed. Green projects tend to they dominate. So things like renewable energy, energy efficiency, terrestrial and aquatic biodiversity conservation, green buildings, clean transportation. The list can go on based on whichever taxonomy you're referring to. But cumulatively, to date, the sustainable debt market, I believe, my last check, is about $4 trillion globally in terms of debt that's been issued. And the large majority of it is going towards these themes. With regard to social, again, those are growing in importance, and they're the same themes that I previously mentioned, where it's affordable housing, access to education, access to essential services, things like that. So particularly socioeconomic advancement, I will say, especially in APAC, that tends to be quite a big theme. And to date, we are still having conversations with investors who will ask us, oh, what do you think is the best project? And we have to say, well, what fits your business? We can't tell you to focus on social if you're not really doing anything there. But something that we do focus on is materiality. So if you are, let's say, a shipping company and you want to raise financing from a green bond, right, we will look at the materiality of that project and the additionality it creates for your business. So what that means is it related to your core business activity? Because there's no point working in shipping and you're raising a bond and you're saying, oh, we're going to educate underprivileged children in Africa. There's kind of no link there. So it doesn't really create additionality to your bond as well as impact. You're not having impact in the right place that would actually allow you to progress further in your sustainable finance journey, as well as your overall decarbonization or greening strategy. Okay, I'll just touch on this very briefly. So we've heard a lot about climate mitigation, which is basically trying to stall or stave off that, however many degree rise in global temperatures. But unfortunately, it is here. We are living it day to day. I'm sure in Singapore, you experience it all the time. I sweat quite a lot, and I really don't like that the temperatures are going up. But we've also seen, especially over the past year and a half, adaptation, which is, I like to say, mitigation's more unloved cousin, has come into the spotlight a little bit, where people are saying, okay, well, the effects are here. Now we have to protect our assets and our businesses against these impacts that are coming towards us. So if you're a data center, you want to be protecting against floods or typhoons that could wipe out your infrastructure. And we're seeing a lot more adaptation-related themes come through in the bond financing. So most recently, this is a good example. Japan actually issued the world's first climate resilience bond that was certified under the CBI guidelines for resilience. And so it's very interesting if you take a look at the use of proceeds. They have allocated it to, I think, 6. Yeah, so a lot of it, as you'll see, is related to kind of proofing the infrastructure, especially in rural areas. So the last one I thought was particularly important or interesting was that they're renovating port facilities in remote islands because, Japan has all these remote islands that are off the coast. They rely on their port infrastructure to bring in essentials, goods, services, and get access to medicines and things like that. So this bond is meant to help shore up those defenses to make sure that the ports are not wiped out in an event of a typhoon or an earthquake or something like that. Also, in terms of earthquakes, Japan is really prone to earthquakes. So they're doing something with regard to utility poles, and I'm sure someone who works in infrastructure will be much better technically explaining this, but just to give you a sense of what the proceeds are being put towards. So I think we'll see a lot more issuance under this particular label, resilience. It is quite a new term. I've not seen that many bonds issued. I think this is really the first one that has come across my desk where I just thought, oh, this is a really innovative structure. And I think that just speaks to Japan's history of trying to innovate. So they have been very active creating their own local use cases and guidelines with regard to transition. They were actually one of the first countries to proceed with a transition strategy and raise transition bonds. So this tracks. And I'm coming up to the end of my presentation here, sir. So if we talk about something that's come up a lot in conversations as well, is the credible transition. So, a few years ago, maybe 5-10 years ago, you heard a lot around, oh, we're creating net zero targets. We have a net zero target. We're going to hit net zero by XX date. And maybe back then, I'm sure there was genuine intent, but a lot of it was also PR, hopping on that bandwagon and saying, we're all for it. We love the environment. Give us your money. Invest in us. But right now, you're seeing a lot of investors and stakeholders come through saying, okay, well, show us what you've done over the past 6, 7, 8 years since you made that pledge. We need to see material outcomes. You can't just be getting away with a fancy press release and, putting out a sustainability annual report that is very sparse in information. So this word has basically kind of been developed by investors saying, we want to know what you're doing. What's your credible transition plan look like? So again, a credible transition plan is a very clear science-based aligned plan that you're using to move your company's operations to a more green way of operating. That's just to put it simply. There are a lot more complex explanations just depending on the sector that you're in, which it's not my area of expertise. And it's also backed by the money that a company is putting towards it. So you can't just make those grand claims and not be putting investment behind what you're saying to show. Because, for us, we're in school, we take exams, you have to show results. And that's basically what this is meant to do. Again, why it's important, you're future-proofing the business. You're making sure that your investors are feeling safe, that they've put their money with you. You're, safeguarding their returns, and also making sure that you remain sustainable in the long run and you're not going to be going bankrupt at some point, hopefully not because of some climate, catastrophic event. So, yeah, this again leads me to this. I think it's my last slide, actually. Yeah, I think it's my last one. Because of all this, we're now seeing a lot more demand from the investor side, actually, for these for research as well as information around the transition label. And when I speak to bank arrangers, particularly in ASEAN banks, that's who I tend to deal with on a day-to-day basis, a lot of them are very interested in this particular product, and they have to advise their corporate clients in terms of how can you raise funding or capital in a sustainable way. And transition is coming up a lot. So as you can imagine, when the guidelines were released from the ICMA as well as the LMA, I started getting a lot of emails saying, can we set up calls? I need to understand this so I can talk to my corporate clients. So hopefully this is the start of the next evolution in terms of maturation of the labels and the instruments that are being deployed to the market. And with that, I'm going to end.